Imagine walking out to your mailbox on a totally normal afternoon, flipping past grocery ads and utility bills, and then spotting an official envelope from the IRS. Surprised, your stomach tightens. You open it, expecting a routine notice at worst. Instead, you're staring at a $10,000 penalty. And the worst part? You genuinely have no idea what you did wrong. You didn't hide money overseas. You didn't run a secret business. You didn't lie on your taxes. Frustrated, all you did was deposit some cash from selling your truck, or your daughter gave you money to help with medical bills, or you shifted funds around so you could finally replace that old roof. Completely ordinary retirement activity. But in 2026, ordinary doesn't always mean safe, because what's triggering a lot of these penalties isn't obvious criminal behavior. It's patterns. Patterns flagged by automated systems that don't know your story or your intentions. And once that system decides something looks suspicious, the penalty meter can start at $10,000 for a single violation. Today, we're going to unpack exactly what's going on, why so many retirees are getting blindsided, and the one simple mistake that can turn an innocent trip to the bank into a federal problem. Hi, I'm Artur, and I spend my time helping retirees protect the nest egg they worked a lifetime to build. And I need to talk to you about a quiet shift that's happened in the financial system this year. The underlying rule we're talking about is not new. It's been there for decades. But the way it's being enforced in 2026 is totally different. Faster, automated, and far less forgiving if something on paper doesn't line up perfectly. My goal isn't to scare you. It's to make sure you understand what's really happening, what kinds of everyday bank activity can trigger a major penalty, and, most importantly, how to protect yourself so you never see that $10,000 surprise. Because once you see how this actually works, you'll realize the danger is not obvious, and that's exactly why it catches people. Let's start with what's tripping people up. Everyday transactions that look completely harmless from your perspective. You sell your old pickup for $15,000 in cash. The buyer counts it out, you bring it to the bank, and deposit it. Your son wires you $20,000 to help with unexpected medical bills. You finally take that lump sum pension payout you've been considering for years. You move a big chunk of savings from one account to another because you're putting a down payment on an RV. None of that is illegal. None of it is shady. It's just retirement. It's your money, being managed like you always have. But here's what's different in 2026. Banks aren't just places that store your deposits. Certain kinds of activity are automatically reported, and those reports don't sit in a drawer somewhere. They're fed straight into automated systems that scan, sort, and cross-reference data, looking for anything that doesn't fit. So, when a large amount of cash suddenly lands in your account, the system doesn't see truck sale or gift from my daughter or pension payout. It sees numbers, it sees timing, it sees patterns. Then it compares those patterns to what's on your tax return and other financial records. If they don't match, the system raises a digital eyebrow. From where you sit, you're just being financially responsible. From the system's point of view, it's asking one very specific question. Where did this money come from, and was it properly reported? If that answer isn't obvious in the data it has access to, that's when the trouble can start. Here's the part that surprises almost everyone. The rule behind all of this isn't new. It's been around for a long time. What's changed is how aggressively and how efficiently it's being enforced. At the center of this is something called a Currency Transaction Report, or CTR. It sounds intimidating, but the idea is simple. By law, banks must file a CTR anytime someone makes a cash transaction over $10,000. That includes cash deposits, cash withdrawals, and some types of cash transfers. If you walk into your bank and deposit $12,000 in cash, the bank fills out a CTR and sends it to the government. You don't fill it out, you may never see it, and you might not even know it happened. It all occurs behind the scenes. And this is important. A CTR is not a penalty. It's not an accusation. It's not proof you did anything wrong. Millions of CTRs are filed every year. For decades, this has been completely routine. Business owners deposit cash, people sell cars, families move money around, the bank files the report, and life goes on. So if that's always been the rule, why are retirees suddenly hearing about $10,000 penalties? Because in the past, most of those reports just sat in databases unless a human investigator had a specific reason to look at them. Today, that's not how it works. CTRs are now fed directly into automated systems that instantly compare them with your tax returns, Social Security records, pension distributions, and other financial data. The system is no longer just collecting information, it's actively analyzing it in real time. When it finds something that doesn't line up, that's when the problems begin. And there's another layer to this that's actually riskier than a straightforward large deposit. It's a mistake people make all the time, thinking they're being clever or careful. But to the IRS, that one decision can turn a legal transaction into a federal violation. That mistake is called structuring. Here's how it usually happens. You have $12,000 in cash. Maybe it's from selling a boat. Maybe it's savings you kept at home. Maybe it's money you've had for years and finally decided to deposit. You walk into the bank, and just before you reach the teller, a thought pops into your head. If I deposit all of this at once, they'll report it. I don't want extra attention. I'll just do part now and part later. So you deposit $8,000 on Monday, then come back on Wednesday and deposit the remaining $4,000. From your perspective, that feels harmless, maybe even responsible. You're not hiding income. You're not lying on your taxes. You just don't want extra paperwork or scrutiny. That sounds reasonable. But under federal law, that choice changes everything. Structuring is when someone intentionally breaks up a large cash transaction into smaller chunks for the purpose of avoiding the $10,000 reporting requirement. And here's what catches people off guard. The money itself does not have to be illegal. It doesn't matter if it came from your pension, the sale of personal property, or a gift from family. If the deposits are split specifically to avoid triggering a CTR, that action alone can be considered a violation. Civil penalties for structuring often start around $10,000 per violation. Let's put the two scenarios side by side, because this is critical. If you walk into the bank and deposit $12,000 in cash in one transaction, the bank files a CTR. That's normal. It's legal. In most cases, nothing else happens. If you decide to deposit $8,000 and then $4,000 specifically, so no single transaction crosses the $10,000 line, you've created exactly the kind of pattern these automated systems are meant to find. They look at amounts, timing, and frequency. If your behavior looks like an attempt to stay just under the threshold, red flags go up quickly. And here's the hard truth. The system doesn't know what you were thinking. It doesn't see, "I just didn't want attention." It only sees the pattern. And in this context, the pattern is what matters. This is how honest, cautious people end up in serious trouble. They think they're keeping a low profile. But in reality, splitting deposits to avoid reporting is what puts them squarely on the radar. So let me say this as clearly as possible. Having a currency transaction report filed on your deposit is not a problem. Trying to avoid that report can be. That's the key shift in 2026. With advanced automation, cross-referencing, and real-time analytics, these patterns aren't slipping by unnoticed anymore. The system doesn't wait for a person to spot you. It flags inconsistencies automatically. It ties deposits to tax returns. It compares reported income to cash activity. And when something doesn't line up, notices go out. Before that turns into anxiety, let's ground this. The IRS is not targeting retirees who are simply handling normal, well-documented finances. The overwhelming majority of people who deposit money properly, even in large amounts, never face a problem. The real risk lies in misunderstanding how the rule works. So here's your first big takeaway. Never break up a deposit just to stay under $10,000. If you have more than $10,000 in legitimate cash, deposit it in one transaction. Let the bank file the report. That is what the system expects. That is what keeps your pattern clean. If this is already making things clearer, take a moment to like the video and subscribe. I share updates like this specifically to help retirees avoid expensive mistakes before they happen. Now that you understand structuring, we need to talk about something just as important: how to protect yourself going forward so that even in this fully automated IRS world, you're never left scrambling to explain your own money. Now that you see where the real risk is, let's move from awareness to protection. This isn't about panic. It's about simple preparation. Even though enforcement in 2026 is more automated, faster, and less forgiving of inconsistencies, protecting yourself is still surprisingly straightforward. You don't need loopholes or fancy legal tricks. You need three things: organization, clarity, and a paper trail. First, document everything. Anytime a significant amount of money moves into or out of your accounts, keep records that clearly explain where it came from and why. If you sell your car for $15,000, get a signed bill of sale and keep it. Scan it and save a copy. If your daughter gives you $20,000 to help with medical expenses, ask her to write a short gift letter stating the amount and that it's a gift, not income and not a loan. If you take a lump sum pension payout, hold on to all the distribution paperwork. If you withdraw cash for a large purchase or project, keep receipts, contracts, and invoices. The idea is simple. If anyone ever asks, you can immediately show both the source and purpose of the money. Most retirees don't realize that the IRS computer doesn't automatically know the context behind your transactions. It just sees numbers. Your documentation supplies the story behind those numbers. And when that story is clear and backed up with paper, questions are usually resolved faster and with far less stress. Second, if your finances are more complex than just Social Security and a modest pension, this is the year to talk to a qualified tax professional. A good CPA does more than just fill in forms. They help make sure your tax return tells a complete, consistent story. If you had a large deposit from selling property, that needs to match what's reported. If you received a sizable gift, they can help you handle it properly. Automation flags mismatches. A tax professional helps prevent those mismatches before they exist. Third, talk openly with your bank. This one surprises people. There's nothing wrong with asking your bank how they handle large cash deposits and reporting. Transparency actually works in your favor. If you're planning to deposit a significant amount of legitimate cash, you can simply walk in, deposit it all, and let them file the required CTR. Remember, the CTR is routine. It's not an accusation. Trying to avoid it is where the risk shows up. When you put these three habits together, strong documentation, professional guidance when needed, and clear communication with your bank, you dramatically lower your chances of ever facing that kind of penalty. Let's zoom out for a moment. The automated systems in 2026 are powerful. They link deposits to tax records. They look for patterns that human investigators might miss. But they are still systems that rely on data and consistency. When your records are organized, your transactions are straightforward, and your tax return matches your real financial activity, you're operating exactly where those systems expect you to be. This isn't about hiding. It's about making your financial story easy to understand on paper. If you know another retiree, a friend, sibling, neighbor, who still believes keeping every deposit under $10,000 is a smart move, share this with them. That old idea can now cost someone $10,000 or more. Because here's the bigger picture. The enforcement shift we're seeing isn't temporary. It's not a trial run. Automation is now baked into how financial oversight works. The systems are faster, more connected, and always on. That means the retirees most at risk aren't the ones committing obvious crimes. They're the ones relying on outdated assumptions. For years, many people believed that if the teller didn't react, it wasn't a big deal. Keep deposits small, don't draw attention, handle things quietly. That was considered cautious. In today's environment, trying to stay under the radar is exactly what can create the radar signature. That's the irony. One straightforward $15,000 deposit with documentation is routine, logged, processed, and usually forgotten. Multiple smaller deposits made with the intention of avoiding reporting create a pattern. That pattern is detected, a flag is triggered, and questions get asked. The system isn't emotional. It doesn't automatically label you as guilty, but it is designed to treat patterns that look like reporting avoidance as worth investigating. And once that investigation starts, it can be stressful, time-consuming, and costly to resolve. Now, let's ground this one more time in reassurance. Most retirees watching this will never face a structuring penalty. Most large deposits, when done properly and backed by clear records, move through the system without incident. The goal here is not to make you anxious every time you walk into a bank. The goal is to replace uncertainty with understanding, because understanding changes how you act. When you know that a currency transaction report is normal, you stop fearing it. When you know that structuring is about deliberately avoiding that report, you stop accidentally creating risky patterns. When you know that documentation tells your financial story, you naturally start keeping the records that protect you. This is really about a mindset shift. The old mindset was, keep it quiet. The new mindset needs to be, keep it documented. That one change can save you a lot of stress. So here's the question I want you to honestly ask yourself. If a fully digital IRS system reviewed your last 12 months of financial activity, would the story make sense on paper? Would every large deposit have a clear, documented explanation? Would the movement of funds line up with what's on your tax return? If your answer is yes, you're in a strong position. If your answer is, I'm not sure, now is the perfect time to organize, file paperwork properly, scan and save documents, talk to a tax professional if anything feels fuzzy, and clear up anything that's unclear. Not because you're in trouble now, but because preparation is always cheaper and less painful than penalties. You spent decades building your retirement savings. You sacrificed, planned, and made careful choices so you could enjoy this stage of life with security and peace of mind. The last thing you want is a preventable $10,000 penalty caused by a misunderstanding of how bank reporting works. The rules themselves haven't dramatically changed. What's changed is the speed, visibility, and automation behind enforcement. And the retirees who do best in this environment aren't the ones who panic. They're the ones who adapt. So deposit large amounts properly. Never split transactions just to avoid reporting. Keep documentation for major financial events. Make sure your tax return reflects your reality. And treat transparency as protection, not exposure. When your financial paper trail is clear, organized, and consistent, automated systems have nothing to question. And that's where real peace of mind lives.